So we started our class discussing what are different types of inflation, and then we did some basic discussion about problems associated with inflation, but we could not complete that. So we'll try to complete that in today's class. Okay. Now, what is inflation? We have already talked in detail. Inflation is persistent increase in general price level. Then we talked about what causes inflation. We identified three causes of inflation: cost push inflation, demand pull inflation, and monetary inflation, right? Okay. Now, after that, we discussed what are different types of inflation, right? So the first type that is desirable for an economy is low and stable rate of inflation. So why is that desirable? Because firstly, the rate is low, which means that it doesn't erode purchasing power of consumers to a large extent. Secondly, it's also stable, which means that it makes it easier for consumers and producers to make their decisions and to estimate how much will be the change in prices of goods in the coming period, and so on and so forth, right? So as long as inflation is below 10%, like a single digit, and as long as it's stable, that's the most desirable thing for an economy, right? And why is it desirable? Because it promotes investment. How does it do so? When prices are increasing for producers, they are higher profit margins, so they are incentivized to produce more. When they do that, obviously there will be overall more GDP, more national income, more output, more employment, right? So that's the most desirable scenario for an economy, low and stable rate. Then comes in accelerating rate of inflation. So I did tell you that accelerating means that every year rate of inflation is higher compared to what it was previous year, right? And that is something that's not very desirable, because firstly, the rate of inflation is rising, which means that purchasing power of consumers is eroding at a faster pace. Secondly, it's also unstable, so it makes it difficult for consumers and producers to estimate changes in prices and to do their planning and estimation and all that, right? Then comes in disinflation or decelerating rate of inflation, right? Disinflation or decelerating rate of inflation is when the rate of inflation is decreasing over time, right? So it's complete opposite of what accelerating rate is, right? And this is obviously, to some extent, this might be desirable because the rate is at least coming down, but still it's not very desirable because it could be unstable, which means making it difficult for consumers and producers to plan. Then hyperinflation, we talked about this. Hyperinflation is when there is a excess money printing happening in the country, and due to that, more money starts chasing fewer goods and services, and overall, money starts losing its value and all that thing, right? Hyperinflation has happened in the past, and this could be very disastrous for an economy and so on, right? And this is the worst that can technically happen to an economy. And when hyperinflation happens, I might not have told you before, countries have to completely change their currency, right? So what happens basically, let me give you a little bit of an overview on this, that countries replace their currency with something new, right? Because the value of money has decreased so much that you literally need, tons of money to buy a small thing, right? And I mean, that's just affecting the way transactions take place and affecting the way economy should operate. So the only solution available to a central bank in that case is to collect all the money from the people and then replace it with new currency notes, replace existing currency with something new, right? So that is what is the only solution to hyperinflation. Okay, then comes in deflation. Can you hear me clearly, right, Khadija? Okay, now deflation is what is opposite of inflation. I did tell you this is which comes with the negative sign. Negative sign meaning prices are decreasing. Instead of increasing, prices starts to decrease. That is deflation, right? Okay, now this being said, okay, great, perfect. Now, deflation is when prices starts to decrease. In a way, it could be a good thing, right? We had detailed discussion yesterday. It could be a good thing. Why? Because consumers' purchasing power is increasing, right? But deflation, the very fact that deflation is taking place shows it is because of the fact that consumers have low confidence and they're not spending a lot. Aggregate demand is exceptionally low. Consumers are not spending, investment levels are low, government spending will be less. So that's why deflation is taking place. So deflation in itself is not something desirable for an economy, right? Okay, then towards the end of yesterday's class, we started a discussion about problems of inflation. We could not complete that but we'll do that in today's class, right? So the first problem of inflation is menu cost. Now, what is menu cost? I mean, menu is the menu that we know of, right? When prices are changing at rapid pace, businesses constantly need to update their prices. They have to constantly update their price information and things like that, right? So this used to be very much true in the past, because everything used to be manually done, like menu cards of restaurants, product catalogs, and so on and so forth, right? But now everything technically is more digital, therefore it is not that much of a problem. But still, this is kind of a little bit of a hassle for businesses to constantly update their prices information on their products, on their websites, and things like that. That's what menu cost is. Then comes in shoe leather cost. What is shoe leather cost? I did tell you that it is when during high inflation, consumers are concerned about erosion of their purchasing power. So they're looking for ways, they're looking for assets where they can get higher returns, right? And when you withdraw your investment from one asset to put it in another asset, then there's some transaction cost that you have to incur, right? So that is shoe leather cost, right? Now, let's talk a little bit about this more and then we move forward. When COVID, hit the world, especially like for the first time, right? People panicked. A lot of people were not sure how will this affect the way they were living and things like that, right? It was quite of a paranoia that it caused because it was complete lockdown and all that stuff, right? So a lot of people withdrew their money from a lot of investments that they had made previously, and they started investing in the basic things, or like real assets meaning gold, real estate like property and things like that, right? So with that thing happening, when they move their money and when they withdraw their money from, let's say, stock exchanges or cryptocurrencies, and they invested in other assets, that involves some transaction cost, right? So this time and the money and the charges that they had to incur is known as shoe leather cost. Khadija, is this making sense? Right? So then another problem with inflation is, another challenge with inflation is inflationary noise, right? Is everything clear so far? Good, right? So the next problem with inflation is inflationary noise. So what happens in inflationary noise? You have to listen to this carefully, right? So when inflation is taking place, right? Or a better way to write this would be, during inflation, right? Okay, great, perfect. During inflation, some producers confuse rise in product prices as increase in their product demand, and therefore they start producing more, which can result in unsold stock of goods, right? Okay, now think about this. So what is inflationary noise? Now, we know during inflation, overall, goods and services are becoming more expensive, right? But some producers confuse this inflation with increase in the demand for their goods, because we do know with that when demand for goods increase, their prices increase, right? So if any producer during inflation confuse rising prices as as due to the demand for its goods is increasing, then they might start producing more, and as the result, they can start building up unsold stock of goods, right? Are you getting me? So let me give you a real life example so that you get a better idea, right? So during inflation, obviously the prices of, let's say, a certain brand of clothes will increase, right? And if that producer confuses this as rise in the demand for its brand, right? Even though it's not the case, prices are rising because of higher cost of production and things like that. So if some producers confuses higher prices with increase in the demand for their products, then therefore they will start producing more of their goods. Why? Because that means that they have higher profit margins, and to benefit more from this opportunity. They might want to produce more, and as the result, they will have some unsold stock of goods, right? So this is what inflationary noise is, right? So it distorts market signals. It distorts market signals, right? It distorts market or price signals. Signals making for producers to differentiate between inflation and demand for their products. Is this making sense to everyone? Okay. So students, think about this. So we are talking about problems associated with inflation, right? So two of these we discussed yesterday. The first one being menu cost, where we said that during inflation you have to constantly update prices of your your price information on your menu cards, on your catalogs, on your websites, and that's obviously time consuming process that might require some resources, and that is what menu cost is, right? Then problem associated with inflation Another problem associated with inflation is shoe leather cost. What is shoe leather cost? During inflation, people are switching their investment between higher yielding assets. So they are in search of higher yielding assets. And as a result, they incur some transaction cost, right? They move their money from one asset to another asset. That involves some transaction cost. That is shoe leather cost, right? Then the third problem with inflation that we have just discussed, now let's look at this, listen to this carefully, right? That's known as inflationary noise. Now, what is inflationary noise? During inflation, some producers confuse rise in product prices as increase in their product demand, and therefore they start producing more, which can result in unsold stock of goods. Now, think about this. We do know that think about this. So we do know that in a normal situation, how do producers respond to increase in demand? During normal periods, think about this. So you have normal down sloping demand curve, you have normal upward sloping supply curve, right? Just a second. And so your normal downward sloping demand curve, upward sloping supply curve, right? Now, if for any reason the product demand increases, what will that do? That will result in extension in supply. Does it make sense or not? That will result in what? That will result in extension in supply, because since product prices are higher, that means higher profit margins for the producers, and hence they will want to produce more. This is making sense, students? Right? So think about this. If you were previously operating at this point, this was the initial equilibrium, this one being your original supply, this one being your original demand, right? So this was where you were operating on the supply curve previously. Now, when the product demand increased to D2, right? So there will be extension in supply. You'll move from this point, let's say point A to point B, right? So that is defined as extension in supply. Yes or no? We did talk about this. So this is what happens in normal situations. Now, if during inflation, producers confuse inflation with increase in demand, what will they do? They will want to produce more units of their goods, right? They'll want to extend their supply, right? Extension supply, right? But what will that do? That will only result in unsold stock of goods, right? Because the demand isn't happening. Demand isn't increasing. What is happening instead? It's the prices that are increasing because of the fact that there's inflation taking place. Yes or no? So if that results in unsold stock of goods, that will be obviously a loss for the producers, right? Yes or no? Making sense? So why is this a problem? It distorts market signals or price signals. It distorts inflationary noise, distorts price signals, making it difficult for producers to differentiate between inflation and the demand for their products. Is everyone clear on this? Students, any confusion so far, please ask me. Right, we good on this? So that's another problem of inflation, right? Now moving forward, right? Okay, so we have talked about three problems of inflation. Then another problem is Uh, that's obviously very obvious. Purchasing power, right? Now, what is erosion of purchasing power? This is something that we have been talking about again and again. So this is when, right, uh, consumers like value of money decreases, right? So basically, at the end of the day, bottom line is that during inflation, money is losing its value. So whatever a unit of money used to buy previously, now with inflation, it will buy less, right? So this is what erosion of purchasing power is, right? So that's obviously another problem. Consumers purchasing power uh, decreases, and therefore people less, right? So what is erosion of purchasing power? During inflation, consumers' purchasing power decreases, and therefore now they're able to buy less with the same amount of money compared to what they were able to buy before, right? Okay, and what type of people does this affect the most? Can you guys think about this? So inflation, my question is, which type of people will be affected most out of inflation? Think about this. What type of people? Like people who are working at some company, or business people, or let's say people on fixed income, or retired individuals. Who are the people whom do you expect to be affected the most out of it? Have a look at this. Okay, this makes sense, students? Retired, exactly, very good, Khadija. Right, so think about this. Why? What happens in the case of retired people? They are getting fixed pensions, right? Now the amount of pension is fixed, 30,000, 40,000, 50,000, whatever the amount is, right? Now every year goods are becoming more expensive, but the income that you're getting in the form of pension, that's fixed, right? So that means you will be able to buy less every year compared to what you used to buy before with that money. Yes or no? Is everyone clear on this? Right, first thing, right? Then if you think of other people, right? So salaried people, or people who are working employees, right, they are also affected, but oftentimes they do get some increase from a year to year basis, right? So if they do get an increase from a year to year basis, then obviously they might be affected, but not as much as people with fixed incomes. So that's why I said that retired people or people with fixed incomes are the ones who are affected the most out of inflation. Yes or no? Is everyone clear on this? We got on this, right? So menu cost, shoe leather cost, inflationary noise, erosion of purchasing power, right? Yeah, so that's about it, right? So these are all the problems associated with inflation, right? Okay, now this being said, right? Just give me a second. Okay, great. Any confusion so far, students? Are we good on this? Okay, now this being clear, so today we'll start off with um, a new topic, which is exchange rate, right? So that was all about inflation. So quick recap, right? So we discussed what inflation is. Then we talked about what are causes of inflation, right? After that, we talked about how inflation is calculated, right? And then we talked about types of inflation, right? That we just revised in today's class. And in the end, we have talked about costs or problems associated with inflation, right? Is this clear, right? And when are these costs higher? When are these problems more severe? So higher the rate of inflation in an economy, more severe these problems will be. What do I mean by that? Think about this, right? So when the inflation rate is very high or when the inflation rate is very unstable, then there will be obviously more menu cost, right? Because companies have to more frequently change their product prices on their websites, on their price tags, on their menu cards, on their catalogs, and so on, right? Similarly, when higher is the inflation rate, then higher will be the shoe leather cost, because people are always looking for better returning assets, and they're moving their money from one asset to another asset, and that will cost them a lot of additional charges and so on and so forth, right? So that's another thing. Similarly, the higher the inflation rate, the more the inflationary noise, because producers cannot really differentiate between whether prices are increasing because of inflation or whether prices are increasing because of higher demand. So there will be more lost with that, right? And obviously, higher the inflation rate, more will be the erosion of purchasing power of consumers, right? So these are all the things, right? So long story short, higher the rate of inflation and more unstable the rate of inflation, right? The more severe these problems will be. Got it? Easy? Okay. Now, after completing off with the topic of inflation, today we'll start off with the new topic, which is exchange rate, right? Now, students, let me tell you where we are going with this, right? So I did tell you that in this unit 4, which is macroeconomics, we'll talk about all macroeconomic variables, which includes the first one that we did, GDP. Then we have just completed off with inflation, and unemployment is also a macroeconomic variable, but I said that we'll talk about this in our A2 syllabus, so we don't need to worry about this now, right? So after this, we have exchange rate, and then we'll move on to balance of payments, right? Okay, now exchange rate is something that we have always, it's not a word unknown to us, right? Because we have always heard of it, and we might have in our life so far come across the concept of exchange rate, right? Now, what is exchange rate? Think about this. Now, every country in the world has its own unique currency, right? It has a different currency, right? Except for European Union, which use same currency, which is euros, but all other countries in the world have their own currency, right? Now, whenever an individual is going from one country to another, they need to have the local currency to be able to buy the local goods and services. Yes or no, right? So think about this. So if anyone is coming to Pakistan, a foreigner, they need to hold Pakistani rupees to be able to make transactions in Pakistan and buy Pakistani goods and so on. Similarly, when a Pakistani is going abroad to any other country, he or she needs to hold that country's currency to be able to make transactions and all that, right? So when you convert one currency to another currency, that is where the exchange rates, or that is basically what exchange rates are. What's the value of one currency in terms of another? That is what exchange rate is. Students, are you following me? So what is exchange rate? Exchange rate is, simply speaking, value of one currency in terms of another. Do you agree with me? Right? So value of one currency in terms of another. Okay. Now, if any point in time you want to find out exchange rate between two currencies, right? Value of one currency in terms of another currency, right? So if any point in time you want to find the exchange rate between two currencies, all you have to do is to just open the Google and write USD, which is US dollars, into PKR, which is Pakistani rupees, right? Or similarly, you can do it like USD into pound sterling, which is dollars into UK sterling, or euros into Japanese yen, or so on and so forth, right? So you can always go on the Google and you see what is the exchange rate between two currencies, right? So that's what exchange rate is. Okay, but what is more important to us as economic student is to understand how exchange rates are determined. So who decides that, let's say $1, right? $1 at the moment, I guess, is around rupees 172 Pakistani rupees. So who gets to decide that $1 will buy 172 rupees, right? Why not $1 equals to 50 rupees? Or why not $1 equals to 1 rupee? Are you getting me or not, right? Okay, now if this is a question that has bothered you, or if this is a question that is of interest to you, then let me tell you that in today's class, you'll find the answer to it. Okay, Now, the idea is fairly simple. Students, think about this. Who is printing these currencies, right? Who is printing dollars? Let's first answer this question. Who's printing dollars in this world, in this entire world? Who's printing US dollars? US dollars I'm talking about, right? So it's Federal Reserve. Federal Reserve is the central bank of United States of America, right? And who is printing Pakistani rupees, right? So the central bank of Pakistan is called State Bank of Pakistan, right? State Bank of Pakistan. So these are the two institutions responsible, only these are the institutions responsible for printing these two currencies, State Bank of Pakistan. Easy? Is everyone clear on this so far? Right? We good? Okay. Now, the value of anything in economics is based on its market forces. What do we mean by that? So what are market forces? Market forces, very good. Yeah. So market forces are the forces of demand and supply. Just like the price of any product is determined by how much is the demand for the good, how much is the supply of the good, with the demand supply of a product meet, that's basically the equilibrium level, right? So that's the equilibrium level that shows equilibrium price and equilibrium quantity and so on, right? So similarly, think of currency as a commodity, as a product, as a normal product, like any other product, like a laptop, cell phone, clothes, cars, shoes, house, right? And so on, right? Okay, now think about this. So what question we are looking at over here? How are exchange rates determined, right? How are exchange rates determined, right? So I did tell you that since currency is also a commodity, the value of exchange rate or exchange rate will be determined by the market forces of the currencies, by the demand and supply of that currency. Okay, now let's talk about this. Think about this. When do we demand? Now, before we jump on to this big question, let's talk about this. When do we demand a currency? Adina, think about this. So when will you demand a currency? Right? So let's say you are, let's take my example, right? So I'm living in Pakistan. I work in Pakistan. I earn in rupees. Now listen to this very carefully. I'm a Pakistani national. I'm living in Pakistan. I earn in rupees, right? So I don't demand rupees. Why? Because I already have it. Now, this is something that a lot of students get confused with, right? So why don't I demand rupees? Because I already have that currency. Let's take a specific currency because then it will be confusing for us. Demand rupees, right? So who demands rupees? Anyone who doesn't has rupees at the moment. Yes or no? If I already hold rupees, why do I need to demand it, right? I'm not going somewhere buying rupees. I already earn my income in rupees, I spend in rupees, and this is how it works for me. But think of a foreigner who's coming from, who's coming outside of Pakistan, and that person wants to spend some time in Pakistan, coming here for a visit, whatever, right? And then that person needs to demand rupees because he can't make transactions in Pakistan without rupees. Am I making sense to you? Right? Yes or no, right? Now that person, now think about this, how this mechanism will work, right? So let's say an American is planning to visit Pakistan, right? So what he will do, he'll go to a bank before his flight to Pakistan, right? Before his flight to Pakistan, it's not that he can't convert dollars into rupees in Pakistan. He can, but let's take a very simple and obvious example, right? So this American, right, goes to any local bank in America before he travels to Pakistan, and every bank in the world converts one currency into another currency, right? So it's not something that you have to go to a special bank, right? So I can just step out of my home, go to any nearest bank, and I ask them to convert this currency into another currency, and they'll give me another currency, right? This is how it simply works, right? So American citizen goes to his bank, right? And then, what will he do? He has dollars lying in his pocket. What currency he has lying in his pocket? Dollars. So what will he do? He will provide dollars to the bank, and in return, sorry, up till now we are doing it like this, right? And in return, he will ask the bank to give him what? give him rupees. Yes or no? Right? So basically what happened, he supplied dollars and he demanded rupees. Listen to this carefully, right? So it's not like another normal transaction, because what happens in another normal transaction when you go to a shop, think of another normal transaction, right? When you go to a shop, you give one currency and in exchange of that currency, you buy some product. In this case, the product that you're buying is also a currency. Khatija, are you following me? Think about this. So this might be a little confusing for you because in any other transaction, when we go to shop to buy something, right? So we give money, we give a currency, and in exchange we buy a product, like, I don't know, a bottle of juice or bread, eggs, whatever, right? In this case, the product that we are buying, we are giving currency, and in exchange we're also getting another currency. But think of it that whichever currency you are providing, you're supplying that thing. What are you doing? You are supplying that currency, right? And the currency that you are demanding in exchange, that you're getting in exchange, you are demanding that currency. What are you doing? You are demanding that currency. Is everyone clear on this? Any confusion so far? We good on this, right? So when will someone demand rupees? A foreigner who is visiting Pakistan, right? So that is one possible scenario. A foreigner who is visiting Pakistan. Okay. Apart from this, there could be some other situations when someone might want to demand rupees. Think of exporting from Pakistan. So when a Pakistani business exports something to another country, they make the payment to Pakistan in rupees. So what they're technically doing, they're converting their currency into our currency. Are you getting me or not? Right? Think about this. So when Pakistan, this is another example that we're about to discuss. So this example was about a foreigner coming to Pakistan, right? Is this clear so far? Now, another example that we're about to discuss, exports, right? So what happens when you export from your country to another country? Right? Now let's assume a scenario, right? Where this Pakistani firm, ABC, right? Sports. So this is, let's say, a Pakistani firm, ABC Sports, that is exporting something to another country, let's say USA, right? Okay, now we export them, let's say any product, I don't know, footballs, right? And they make a payment to us, right? Now there are two possibilities. Either they can make the payment in their own currency, like dollars, or they can convert their currency into our currency, which is rupees, right? So we'll discuss both possible scenarios. Okay. Now, if they're making the payment to us in rupees, right? So let's first talk about this scenario where they're making us the payment in rupees, right? Now, what will this US firm do? This US firm will go to its bank account, right? And they will ask them to convert their dollars into rupees, right? Whatever equivalent amount of rupees is, and then they will make that transfer to Pakistan. This is making sense, right? So this is how it works. So technically what happened, that they went to their bank, they supplied their currency, which is dollars, and in exchange, they demanded rupees. So in a way, they did demand rupees when they bought a product from Pakistan or when they imported a product from Pakistan. Khadija, are you following me? Right? Another scenario in this case could be that they're making the payment to Pakistani company in dollars, right? So another possibility could be that they're not giving us the payment in rupees. Instead, they're making us the payment in dollars, right? So they are, let's say, making a payment of $1,000, whatever it is. Okay, fine. So this Pakistani firms get the payment in dollars. Fine, fair enough. But then what will happen? Can this Pakistani firm spend in dollars in Pakistan? Would they pay wages of their employees in dollars, right? Even though if Pakistani company is receiving the payment from US company in dollars, my question to you is, will this Pakistani firm provide or pay wages to its employees in dollars? Or will it pay its employees in rupees? The answer is it will pay its employees in rupees. Why? Because obviously this is how it works, right? That's the local currency. That is the money that they will spend in buying whatever goods and services they need, right? So at the end of the day, this Pakistani firm will go to its bank, give dollars, and in exchange get rupees. So in the end, what's happening? In every possible scenario, it's dollars that are being supplied and rupees that are being demanded. Khadija, are you following me? At the end of the day, what's happening? It's dollars being supplied and rupees being demanded, right? So another possibility that when this was the first scenario where a foreigner is visiting Pakistan, great. Another scenario where there will be increasing demand for rupees when Pakistan is exporting something. Pakistan is exporting something. Easy? Any confusion so far? We good on this? Right? Okay. Now let's stick to these two examples, right? There's another example, like there's another situation, right? Another possibility when demand for rupees will increase, and that is when a foreigner is investing in Pakistan, right? Foreign firm investing in Pakistan, because again, same thing applies. So foreigner will have his or her money in dollars or whatever currency, right? And then when they have to make a payment in, like when they have to invest in Pakistan, they have to acquire assets, they have to rent out premises and all that stuff. They will convert their currency into our currency, right? So that is foreign investment in Pakistan. Foreign investment in Pakistan. Easy. We good on this? Any confusion so far, students? Anything that's not clear? Anything you want to ask me, right? Okay. Now, if you just reverse these things, right? When do we supply rupees? Now comes in the other side of it. That was one side where we talked about when a currency is demanded. Now, the other side of the transaction is supply of rupees. When do we supply a currency, right? Now, just like in previous examples, we looked at how dollars was being supplied. In the same way, you can think of how rupees will be supplied. Now, think about this. Who supply rupees? Who in this entire world has rupees? Who has rupees? Who is currently holding Pakistani rupees? Obviously, the people who live in Pakistan. Khadija, are you following me? So the locals, the citizens of that country who hold that currency, they are the ones who will supply it. Easy? Making sense? Right? So supply of rupees is coming from Pakistan. And when will that happen? So that happens when a Pakistani visits a foreign country, right? Because the same process takes place. So if today I decide to visit another country, can I spend rupees? Can I spend in rupees in that country? No, right? So what will I need to do? I need to go to my bank, convert my currency, which is rupees. So I'm basically supplying rupees, and in exchange, I'm demanding the other currency of the country which I plan to visit. So that's how I'm supplying rupees and demanding the other currency. Yes or no? So a Pakistani visiting a foreign country, visiting another country, easy. This is simple, right? Okay. What could be another situation? What could be another possibility, right? A Pakistani investing in another country, right? So we are just reversing all the scenarios that we did previously, right? Can you see here? So we are just reversing these. So in the first case, it was a foreigner visiting Pakistan. Now it's a Pakistani visiting a foreign country. Then in the second scenario, it was Pakistan exporting something. Now if a Pakistani is importing something, like buying a product from another country. And the third scenario was foreign investment coming to Pakistan, and in this other case, it will be a Pakistani investing in a foreign country, right? A Pakistani importing something from another country, right? Importing from another country and a Pakistani investing in a foreign country. Easy? foreign country. Got it? Okay. Now we are coming to, very nice, excellent, right? Now we are coming to, let's do a quick recap and then we are coming to the main part of it, right? Okay. Now we started a discussion about what is exchange rate. So exchange rate is basically value of one currency in terms of another. So how many units of one currency do we need to give up to buy certain units of another currency, right? So that's what exchange rate is, right? Then we said that just like prices of other products is determined on the basis of their demand and supply, right? So just like the price of a laptop is determined by how much is the demand for it in the market and how much is the supply of it in the market, right? Similarly, think of currency as a commodity, as a product, right? So the value of currency, which is exchange rate, will also be based on the demand for the currency and the supply for currency, right? Then we discussed in detail that who determines demand for any currency, right? So we said that anyone who doesn't hold that currency at the moment, those are the people who will demand it, right? Because they are the ones who are going and buying it technically, right? So we discussed three possibilities: a foreigner who is coming to your country, a pocket, when your country is exporting something to another country. So that is when foreigners will demand your currency. And in the third situation, when there's a foreign business investing in Pakistan or your country or whatever, right? And vice versa, when you think of supply, so when your national is visiting another country, when your national is importing something from another country, and when your national is investing in another country, right? So that is when you supply your currency. Okay, now let's come to the main graph now. Now we're about to look at the graph for exchange rate, right? Now, just like we have the market equilibrium graph that we have been looking at again and again, right? Downward sloping is the demand, upward sloping is the supply, and on the y-axis you have price, on the x-axis you have quantity, right? So very similar will be the graph of exchange rate, but have a look at this, right? So let's say now we are looking at the exchange rate between dollars and rupees. What are we looking at? Exchange rate between dollars and rupees. So what have I written over here on the y-axis? Let's look at this, right? So I have written this as dollar per rupee. So either you can write it down like this, dollar per rupee, or you can write it down as dollar slash rupee. This means how many dollars will each rupee buy? Like for 1 rupee, how many dollars will you buy? $5, $0.5, $0.1, what, right? So that is what I'm showing you over here, right? And on the x-axis, you will have Q of what? Quantity of rupees. So why have I written rupees on the x-axis and why have I not written dollars on the x-axis? This is an important question. Listen to this carefully. So whichever of the two currencies is coming in the second place on the y-axis. Whichever of the two currencies, I'll show you some other examples as well, and that will help you better understand, right? Whichever of the two currencies coming on the second, which is on the second, right? So dollar per rupee. If this would have been rupee per dollar, like how many rupees each dollar buys, then you would have written quantity of dollars on the x-axis. But now, since it's not like that, it's dollar per rupee. So it's the second currency that will be, the quantity of rupees will be on the x-axis. Easy? Okay. Now you will have a downward sloping demand for what? This is the currency we are recording the demand and supply of, right? So you will have downward sloping demand for rupees, and you will have upward sloping, just like any other product, you will have upward sloping supply of rupees. Confusion? Any confusion so far? Students, please ask me, right? Now, where the demand and supply intersects, right? That's the equilibrium point. Where the demand supply of currency intersect, that's the equilibrium point, and that shows you what, right? How many dollars will each rupee buy? So if I write this as this, right, $0.5 per rupee, this means that each rupee is worth 50 cents. Each rupee is worth 50 cents, yes or no, right? So either you can write it down like this: 1 rupee is equals to 50 cents, right? 1 rupee is equal to 50 cents, or you can write it as $1 equals to 2 rupees or something, right? Yes or no, right? It's not making any difference. It's the same thing. Okay, now I'll give you some examples and you need to tell me, Khadija, is this clear so far? I'll give you some examples. I'll ask you a few questions and you need to tell me that what will happen in each case, right? Now, let's think of the first scenario where there is more more investment coming to Pakistan. So let's think of the first scenario as more investment coming to Pakistan. So my question to you is, how will we show that on this graph? How will we show more investment coming to Pakistan on this graph? Yeah. Think about this. Think of the same thing that we discussed previously, right? That when a foreigner is thinking of investing in Pakistan, so they have their money in some other currency, right? When they come to Pakistan, they will need to convert their amount, their money into rupees, right? And with that happening, what they're doing. So technically, exactly, excellent, right? So with that, the demand for rupees will increase, which means a rightward shift in demand curve, right? So the demand will move to D1. And as a result, what will that do? That will mean higher or stronger exchange rate. That will mean stronger exchange rate of, right? Stronger exchange rate of rupees, right? Now, this means, let's say, previously each rupee used to buy $half or 50 cents. Now, let's say each rupee is buying you. Now, each rupee is buying you $1. Easy. Is making sense? We got on this? Any confusion, students? Khadija, is there any confusion, right? We got on this? Okay, let's think of another scenario. So in another scenario, let's say more Pakistanis are visiting, more Pakistanis are visiting foreign countries, right? So then how will we show that on this graph? So if more Pakistanis are visiting, foreign countries, how will we show that on this graph? Yeah. Right. So that means that everything else constant, if more Pakistanis are visiting foreign countries, think of the entire process that we discussed, right? This means these Pakistanis will go visit the banks, right? Convert their rupees into dollars, right? They'll convert their rupees into dollars. And as a result, the supply of rupees will increase. The supply of rupees will increase. Right, exactly. That's a good question, Khadija. I'm glad you asked this, right? So demand for dollars will increase. But think about this, Khadija, are we showing the demand and supply of rupees or dollars in this case? Because think about this, whenever there is one transaction taking place, it involves two currencies. But the question that you need to ask yourself that which currency you're looking at from which currency's perspective you're looking at from. So as you can see here, have a look at this, right? So if you see here, on the x-axis, that's why it's very important to remember which currency we are making the graph for. So we're making the graph for rupees. So you supply rupees and exchange, you get dollars. So since we are showing it from the perspective of rupees, that's why over here on this graph, we are only showing the increase. We are only showing increase in supply of rupees, right? Is making sense? Got it? Right? Right? So we can also show it the other way around. You're very right, but at the end of the day, it will have the same effect. It will have the same effect, right? So when more supply of rupees on the market, right? Or, right? So that means, right? So our exchange rate will become weaker, right? So previously, if each rupee used to buy 50 cents, now let's say each rupee is buying you 30 cents, right? So our currency depreciated. Our currency depreciated. Our currency became weaker. Yes or no? Okay, so Khadija, will stop here for today. Tomorrow we'll continue from here, right? And I'll give you a quick recap tomorrow of everything that we did, and then we'll build on that. Got it? And if there are any questions regarding today's class which you didn't understand, you can ask me in tomorrow's class, right? Okay, so I'll see you tomorrow. Take care and have a good night. Bye.